Hi, this is Michael Neuenschwander with Outlook Wealth Advisors. Welcome to the channel. I'm a CPA, Certified Financial Planner. Today we're going to be talking about how your taxable account can facilitate your tax savings. Now, in a prior video, we talked about tax strategy and involving proper use of that taxable account, but now we want to take a step back for a second and really drive home why a taxable account can be so valuable in implementing Roth conversions. So normally, when we look at a conversion, we want to care about the rate that we're paying, today versus the rate we're paying in the future. And in the future, that may entail required distributions. That may entail what if one spouse passes away. So the rate is not just what does the rate change to maybe in a couple of years, but going a little farther than that. So for instance, if we were to pay 22% today in order to convert dollars from your IRA, but avoid 25% down the road, well, that'd be a tax benefit. We'd be saving roughly 3% on every dollar we can convert. And so if we could do that, we want to do that all day long. Now, if we're paying those taxes from the taxable account, it says you can actually afford to pay a little higher rate. And so we'll show you an example, a simplified example. So if we're looking at paying 22% on a conversion, or we're paying 22% on a withdrawal. So if we did no conversion and we left that money in the IRA, but by paying the conversion taxes out of the taxable account, in effect, we're getting more dollars into that Roth IRA, and we're using up what we called the leaky bucket, earlier in favor of keeping more on the tax-free side. In using this strategy where we use the money from the non-retirement or the brokerage account to pay the taxes, we're paying taxes partially on money that was going to show up as taxable income anyway, but in order to keep the Roth intact or as much as possible. So the tax savings by using this account strategically and doing a Roth conversion can generate additional value over time. So now this is not just where the tax benefits stop, though this taxable account will also aid in giving you a larger Roth conversion target, meaning most of that money doesn't show up as taxable income. What I mean is if we have to pay $20,000 in taxes at the end of the year, well, we may have that $20,000, but to get it from the taxable account, we may only need to recognize $1,000, $2,000 of capital gain to get that 20. So in essence, it saves money on taxes as well when we take the money from there. It also may potentially help avoid this other thing we call IRMAA. And IRMAA has to do with how much do they charge you for your Medicare. So we're going to break this down into a couple of different scenarios of what do you need to look at before age 63 and what do you need to look at after. So right off the front, it's important to know how does your income stack up in the eyes of the IRS. So capital gains will always still count as income when it comes to IRMAA. However, capital gains can also be tax-free or they're taxed at 15%. So they'll charge you less in actual tax, but they still come into play when it comes to IRMAA. So whether you max out the 22% bracket or whether you leave extra room and those capital gains are only taxed at 15%, there may be some extra tax savings by putting your after-tax money or your after-tax account to work for you when it comes to Roth conversions. So let's take a look at age 63. And the reason 63 is important, 63 is when they actually start looking at your taxes to determine what are they going to charge you for Medicare. And you say, well, hold on, Michael, isn't Medicare not till 65? That's correct. But for tax purposes, they're beginning to look at your income at 63. So there are certain thresholds. Today, they are adjusted for inflation, but today that threshold for a married couple is around $216,000. But that includes all income. So that's not after your deductions, that's not taxable income, that's your gross income. So suppose as you looked at that number and said, based on that, you could still do a Roth conversion of $120,000. Now, if we looked at some simple math, suppose based on today, that means you could still do a conversion of approximately $120,000. And that's assume you're paying that money with those after-tax, account. However, you could do a Roth conversion of about $120,000 if you were converting it out of the IRA, meaning part of the money would need to go right to the IRS, part would end up in the Roth account. However, if you were to use your taxable account to pay those taxes, you could get the full $150,000 into the Roth. You don't need to lower that conversion to make room to pay for those taxes. You can get the full amount into the Roth IRA. Now, when it comes to maxing out the income bracket, we still have room to generate some capital gains and not see a change in the tax rate. So in this scenario, you can take $28,000 in taxes from your taxable account. So that's where the difference is. By paying that $28,000 from the taxable account, that full $150,000 got into the Roth IRA. Now that $28,000 may generate a little bit of capital gain. They said in most cases, it may only be a few $1,000s. And as we talked about at the 15% tax bracket, maybe that few $1,000 of capital gains really only adds up to about another $1,500 in actual taxes. So in looking at how we put this together and utilizing that after-tax account, quite simply, it allows us to get more converted into the Roth while still making sure the taxes are paid. And that's a key strategy. If we're doing that before age 63, we don't have to worry about IRMAA. We don't have to worry about extra charges for Medicare. But at 63 and beyond, and so let's make that clear, the year you turn 63 is the tax return that the IRS begins to start looking at. And that's where IRMAA comes into play, and they add up all of your income. So they count the Roth conversion, they count capital gains, they count Social Security, etc. So almost everything goes into IRMAA. And one quick word of warning, there is no grace when it comes to paying extra for Medicare. If you cross over that IRMAA threshold by $1, you may as well have crossed over it by $20,000, $30,000. So from a planning point of view, we always stress we want to come to IRMAA, but then back off and leave perhaps $5,000 to $10,000 of cushion just to make sure you don't inadvertently go over that threshold. So when it comes to how we would use that after-tax account to optimize a Roth conversion after age 63, it says, well, let's assume we're going to use $120,000 conversion in this example. But in doing so, if you were to pay it all from your IRA, you can actually only convert about $97,000. And the reason being, even if you wanted to do 120, you'd be banging up against that IRMAA. So once again, you'd find if you use the after-tax money instead, you'd have a little bit more room, even though IRMAA is still a consideration, because that money would be coming potentially only generating a marginally small capital gain. You don't have to recognize the full $28,000 that would go to the IRS to pay the taxes. You may only have to recognize the $2,000, $3,000, $4,000, $5,000 of capital gain. Still counts towards IRMAA, but that difference allows you to move perhaps another $10,000 or $15,000 into the Roth. Therefore, while you may not be able to convert the full $120,000, you would get a whole lot closer to converting 115 or so of it and only having to hold back a little bit in terms of planning of recognizing a capital gain. And that's if you want to make sure to avoid IRMAA altogether. For many people, to be honest, avoiding IRMAA, though, is almost impossible. If you have good income or a significant amount of IRA money, you may have to accept the fact that in order to generate a much Roth conversion, you may be into IRMAA by a tier or two. But IRMAA is also not the end of the world. To be fair, that first tier of IRMAA is approximately $75 for Part B of Medicare, maybe another $10 or $15 for Part D. So figure $85 to $90 per month per person. If we add that up for the whole year, though, we're generally talking $2,000 of extra taxes that are technically due in 2 years. Because the way they collect on IRMAA is they take it from your Social Security. It doesn't actually appear on your tax return. You'll just get a letter down the road that says because of your higher income, they're going to charge you more for Medicare and they're going to take it right out of your Social Security check. So think of it as it is a tax, but it's a tax you pay 2 years later. But in the big scheme of things, if that $2,000 of extra tax lets you get $30,000, $40,000, $50,000 more into your Roth IRA for tax-free growth, that may be a trade-off that's well worthwhile. So when we talk about tax benefits and using each accounts to their full advantage, This is why tax planning is such an integral part of the retirement process and a big integral part of what we do. Unfortunately, we can say in the financial industry, a lot of the big giant firms aren't allowed or don't have the knowledge to dig into the tax code. So this, in many cases, is why it's important for somebody to work with somebody that understands both the investment side of things, but also how the taxes and the other pieces fit together. So planning in conjunction with income, investments, and taxes, we think is part of the real recipe for success in retirement. So if you're looking to identify additional tax traps or things you want to avoid like this in retirement, feel free to subscribe, reach out, comment. Happy to have a more involved conversation if you'd like some direct one-on-one information. Thanks again for joining us. Hopefully this was beneficial to you. Have a great rest of the day.